I am genuinely excited for today's video because Bitcoin has reached a major support region and the battle to reclaim the 50-week moving average is underway. This setup is giving me strong reminders of our earlier version of the how low will Bitcoin go chart when everyone insisted it was impossible for Bitcoin to drop below 80K because the US government was preparing a strategic Bitcoin reserve. But a few weeks later, Bitcoin was testing that same support level. By then, the narrative had flipped and people believed there was no chance we would bottom there because tariffs were going to crush the markets. Yet that point did end up being the local bottom, and just a few months later, Bitcoin was back to setting new all-time highs. The same story repeated with our first ever How Low Will Bitcoin Go chart from June 25, 2024, when the crowd was celebrating ETF inflows and convinced that Bitcoin could never return to 50K. A few weeks later, Bitcoin was testing that same region again. Then came the panic over the Japanese yen carry trade implosion, which was supposed to trigger a global recession. But once again, a few months later, Bitcoin was breaking out and setting new highs. Am I certain this time will play out exactly like the previous two and that Bitcoin will bottom here before making new highs in the months ahead? Of course not. If I were completely sure, I would not be sitting on nearly 29% cash. However, the broader macro trend still looks intact. I hold more spot positions than cash because my base case remains that we have higher to go until the market proves otherwise. I understand why many believe this time is different from the last two. The United States government is facing a shutdown. The Federal Reserve is leaning slightly more hawkish than expected. The 4-year cycle risk is back in focus. But there were also fearful narratives at the previous local bottom. The tariff tantrum was in full swing. The stock market was sliding. Many thought the AI bubble had finally burst. The headlines then sounded very similar to what we are hearing today. Back in August 2024, the fear was the same. The stock market was correcting. The Japanese yen carry trade was collapsing. Analysts were calling for another Great Depression. In September 2023, the SEC turned its attention to Coinbase and Binance. People declared the entire industry finished. At major tops, the stories flipped to overconfidence. When BlackRock first filed for the ETF, investors said corrections were impossible. When Bitcoin ETFs officially launched, money rushed in. Huge inflows made everyone certain we were headed straight to 100,000. When Trump won the election, the talk of a strategic Bitcoin reserve convinced many that 200,000 was next. And more recently, Bitcoin treasuries began accumulating, sparking the belief that prices would surge immediately. There are always bearish stories at lows and bullish stories at highs. The only thing that matters is the trend. We adjust when the trend breaks. Until it does, the base case remains that we follow the trend higher. 20 to 30% drawdowns have been a normal feature of this Bitcoin cycle. We saw them in May, June, July, and August of last year. We saw them in March and April of this year. We are seeing them again now. Eventually, one of these will turn into something larger, but until the trend breaks and the market confirms it, it is too early to conclude the cycle has ended. These fearful stretches are never easy. The market is falling. Altcoin holders have been promised alt season again and again. Many tried leverage trading because influencers called it free money and encouraged them to use referral links that pay commissions every time someone gets liquidated. We also see increasingly bearish targets like 60, 50, or 40,000 during these drops because those numbers attract engagement on YouTube and X. Traders are anxious because Bitcoin is breaking its range, similar to March 2025 and July 2024. Those breakdowns were later reclaimed, and that could happen again, but the recovery needs to come quickly. Bitcoin spot ETFs are still showing outflows, similar to what we saw in February and March of this year. These flows tend to move with sentiment. The largest inflows happen when greed is high. The biggest outflows happen near local bottoms when fear dominates. Many long-term investors still carry emotional scars from past cycles. They notice that the timing from bottom to top has mirrored previous patterns almost exactly up to the October peak. That has led some to start taking partial profits. These holders are not selling out entirely. They are simply securing gains on rallies and buying again on dips. MicroStrategy continues to face selling pressure, but the chart suggests a potential short-term bounce. The price traded below the previous range low, then closed back above it. That kind of range reclaim often precedes a short-term recovery. Investors might be showing renewed interest because of the recent STR offering and the potential for MicroStrategy to purchase more Bitcoin in the short term. Rather than trying to decide whether the bearish or bullish narratives are going to be proven right, I prefer to keep things simple and focus on the 50-week and 200-week moving averages. Historically, Bitcoin has always drifted back toward its 200-week moving average during bear markets. The further the price moves above it, the greater the downside risk when the inevitable mean reversion happens. The closer the price gets to it, or ideally when it trades below it, the better the long-term entry point tends to be. The 50-week moving average plays a different but equally important role. Bitcoin often retests it throughout bull markets. However, once the price falls below that level, it has consistently signaled the start of a bear market. Its accuracy in identifying bear markets has been 100% so far. Seasonally, November has started weak, but there is still time for momentum to shift. Many investors are capitulating here and turning bearish. As long as Bitcoin continues to hold its current support region, the expectation remains that the next move is higher. Bitcoin's MVRV ratio is sitting close to the same level it reached during the April 2025 bottom. This suggests that investors are holding fewer unrealized gains at the moment. Another way to interpret this is through the supply and loss metric, which has now climbed to a level consistent with the past 3 local bottoms. Short-term holder SOPR is also signaling capitulation, similar to what was observed at previous major lows. There are still several positive catalysts on the horizon. The United States crypto legislation is moving through Congress and is only delayed by the current government shutdown. This includes both the market structure bill and the stablecoin bill. The shutdown has temporarily tightened liquidity, but it will reopen soon. Beyond that, the Federal Reserve is expected to stimulate the economy into another expansion phase due to the direction of fiscal and monetary policy over the coming year. The global liquidity index has remained choppy, and that has translated into uneven Bitcoin price action. However, the Fed will likely have to cut rates more than the market currently anticipates. It is unrealistic to expect only 3 rate cuts in the next 12 months. The recent hawkish tone has lifted the dollar, but that strength should fade once the Fed acknowledges the need for deeper easing. Rates cannot stay elevated for an extended period without severe consequences after a decade of ultra-low levels. Quantitative tightening is scheduled to end on December 1st, and quantitative easing could return soon after. This should support a breakout in the global liquidity index and place upward pressure on gold and Bitcoin. They may not rise at the same moment, but Bitcoin is expected to perform well during gold's consolidation. The current challenge is simply moving past the fear and uncertainty surrounding the 4-year cycle. It is notable that even JP Morgan now holds a more bullish outlook on Bitcoin than many retail holders, stating that Bitcoin appears undervalued compared to gold. While 170,000 is unlikely to represent fair value, it is still remarkable that a major institution is more optimistic than many Bitcoin advocates on social platforms. The S&P 500 is experiencing a modest pullback, which is placing some downward pressure on Bitcoin. This is not unexpected after a near 40% rally since the tariff lows. The broader trend still looks constructive. Real GDP remains positive and is projected to increase in the 3rd quarter, driven by heavy AI spending. The Fed will have to ease policy because of a weakening labor market, even as inflation stays stubborn. Once the government shutdown ends, the incoming data should confirm that view. Ethereum is also showing clear signs of capitulation this week with a solid rebound off the 50 and 100 moving averages. A close above the mid-range level around 3,400 would be ideal. This asset has experienced a turbulent cycle. A range was established early in 2024, followed by a deviation below it, then a move above it, then another deviation back down. When sentiment collapsed and most traders gave up, Ethereum staged another move higher, sparking euphoria and renewed buying as figures like Tom Lee called for 50,000 Ethereum. Now it is once again trading in the same range it has occupied for nearly 2 years. ETF outflows have appeared here as well, and Ethereum Bitcoin remains in consolidation. Bitcoin needs to confirm a local bottom before Ethereum can start outperforming again. For now, uncertainty keeps large inflows away from Ethereum while Bitcoin rests on a key macro support level. Altcoins have seen a small bounce over the past few days, but a true alt season will not begin until the Russell 2000 enters price discovery, which has not yet happened. Ethereum also needs to break into price discovery alongside it. Those conditions have preceded the last 2 alt seasons and are expected again. Solana is likely to keep chopping as long as Bitcoin and Ethereum remain range-bound. It is positive to see ETF inflows continue for Solana, confirming its place among the major 3 assets with Bitcoin and Ethereum, but meaningful upward movement will likely depend on Bitcoin confirming a bottom and reviving market confidence. Performance comparisons over the next year will look weaker because they will be measured against the post-election rally from November 2024. Nevertheless, Bitcoin, Ethereum, and Solana are still expected to outperform the S&P 500 over the next 12 months. Looking further ahead, the United States federal government continues to run large fiscal deficits. That trend is worsening each year. Exponential debt growth leads to exponential money supply growth as the currency is debased. This remains a structural tailwind for risk assets priced in fiat, such as the S&P 500, and for fixed supply assets like Bitcoin. Thank you for the continued support on the recent videos.